All right, we have Manishi Raychaudhuri joining us this morning. Manishi, good to have you with us as always. To start off with, it was a shaky last few days. Not this week, but towards the close of last week with the tech sell-off on Wall Street. But we seem to be holding steady. What's top of mind for you currently as we tackle the equity markets?
As far as the global and regional equity markets concerned, we have obviously seen this massive liquidity-driven rally, and it's no surprise that the markets are taking a breather right now. It also has to be pointed out that much of this market movement, both in developed markets and emerging markets, have been driven by a narrow set of stocks. In fact, if one looks at the top 10 return contributors in the various Asian markets, it would possibly range from 56% to somewhere around 90 to 95%, depending on which market you look at. Which means that, somewhere close to 60, 70, or 80% of the market's returns have been contributed by just the top 10 companies. So this kind of a narrow market movement obviously had to, I would say, take a breather, because the stocks that drove these returns were actually becoming over-owned. Investors are clearly conscious of that fact. So I think, this kind of a sideways movement, and the kind of correction that we are seeing, it may continue for some more time.
All right. Back home, I think the Achilles heel has been the financials, Manishi, with some bit of a cloud with regards to wondering whether that NPA picture is going to balloon, even though most of the major banks have had some fairly reassuring comments, and even the RBI seems to have been on top of it. What for you is going to be critical on this front? Are you waiting for the financials to play catch up? Are you also cautious?
Well, to some extent, the financials did play catch-up after the late March bottom. They did recover somewhere, close to 30 to 40%, in some cases even higher. But now I think the investors' attention is focused on the post-moratorium scenario. And at the end of August, the moratoriums have expired. And how would the different kind of borrowers react to to this new scenario? How many of them would actually be able to repay? What would be the Supreme Court's final contention about interest payment on loans that were under moratorium? These are various issues that the investors are currently struggling with. And until and unless we have some degree of certainty, which unfortunately may not emerge right away, we would see this one step forward, two steps back kind of a movement in that sector. That said, there are certain banks which are clearly better placed in the Indian context than others. We still like the private sector banks, particularly those which are retail lending focused. And it's no surprise that their percentage of loans under moratorium are significantly lower than the public sector banks. So, our focus still remains on the private sector banks, on select insurance companies, and on select housing finance companies.
Sure. Manishi, are there newer opportunities emerging in the market? For instance, we were just culling out data on how some of the MNC pharma stocks have done, and they seem to be still under-owned, and it seems like there's enough headroom for them to play catch-up with the domestic pharmaceutical names. Also, valuations are still looking attractive.
Well, pharmaceuticals is one sector in general that has done well, not just in India, but across the region. And, one doesn't have to look far to search for a reason. Not just the drug manufacturers, but also other healthcare supplies manufacturers in Southeast Asia. They have done tremendously well. We think that this trend is likely to continue. Selectively, in case of India, I think particularly the selective generics manufacturers or the manufacturers of new APIs, they could continue to do well, and in particular those who are able to sort out their differences with the regulators in different regions. Now, having said that, in fact, if I go back to your original question and leave out just the pharmaceutical sector, there's one very interesting trend that we're seeing, not just in India, but across Asia. If one looks at the sectors which are improving in terms of their earnings estimates going up, and that's really happening over the last 2 months, increasingly we're seeing some cyclicals joining that crowd. Earlier, I mean, if I go back about 1 quarter or 2 quarters, the only sectors which had relatively robust earnings estimates were tech, telecom, internet, all across Asia. Those, you could count them on your fingers. Now that earnings recovery or earnings positive inflection, as we call it, that situation has become much more broad-based. We're seeing cyclicals, we're seeing materials, industrials in North Asia. We're seeing financials both in South Asia and North Asia, which are joining that club. It may be too early to conclude that we are in an environment of sustained earnings recovery, but the initial signs are clearly encouraging.
Contra themes, Manishi, that interest you right now? We were just chatting with a market expert just yesterday, in fact, and he said from a 2 to 3 year perspective, realty is the hot space to bet in on right now, because eventually the space is going to recover. It's been suffering for the last 7 to 8 years. Real estate has been in downturn, but right now is the time to bet on these names.
I think opinion is divided on this right now, and the jury is still out. While the point that you make about the sector being down in the dumps and real estate prices sort of crawling downwards is correct. At the same time, we could actually see lesser demand for commercial real estate going forward, because I think the fact that working from home, working from remote locations can be an effective solution has only been discovered very recently. And as a consequence, we might see many of the service providing companies, which can afford to have a significant part of their employees working from home or working from outside the expensive cities, actually go for that option. Our recent discussions with many of the IT service providers actually points us in that direction, that many companies might actually look at reducing their operating costs through that route, which is obviously not good news for commercial real estate. We are recommending that clients play the real estate sector through the housing finance companies, which are possibly an easier and a better way to play them. We could potentially have the market leaders in this respect outperform going forward.
Manishi, the real anchor move has been there in US tech stocks. US tech stocks have corrected on Thursday and Friday. And typically when market leaders, they correct, global equity markets, they tend to sweat a lot. This time around, there is no sweating. 2 days of big selling and Asia is doing okay. It did okay yesterday. It's doing reasonably okay today also. So do you think we should not get fixated with what is happening to US tech and then make a view on rest of the world? Because that's been the challenge, that it's been a narrow market led by US tech, and because US tech has gone higher, rest of the stocks are following it.
As I pointed out earlier, that the whole question at this point of time is in which sectors would fundamental performance in terms of earnings growth and earnings estimate revisions upwards percolate down to. And while about 2 to 3 months ago, or maybe a couple of quarters ago, that was only the tech sector, both US tech, that's the tech services, and the tech hardware manufacturers in Asia. Now we are seeing that earnings estimate surprises and the earnings estimate increases, they're actually getting more broad-based. We're seeing that in materials and industrials and financials, the classic global and domestic cyclicals. In some cases, they're actually aligning with what's happening macroeconomically in various countries. So, for example, close to home in India, we are seeing that rural economy or rural incomes are actually something positive that's happening to the economy, even when the recent GDP growth numbers, or the decline numbers rather, came out. Agricultural GDP growth was still pretty decent. And it's no surprise that within Indian automobiles, we are seeing two-wheelers and tractor manufacturers' earnings expectations being revised upwards. Similarly, in North Asia, in China, it's actually infrastructure development which is the big story over there, which the governments are doing to counter the negative economic impact of the COVID outbreak. And as a consequence, we are seeing industrial companies and the capital goods manufacturers having earnings estimate increases. So, as a consequence of what's happening macroeconomically, if we're seeing, a percolation or, a broadening of the earnings surprise base, I think that could go a long way in assuaging the investors' concern about, about a correction in this narrow market. And I think that's exactly what we're now beginning to see.
Manishi, if everybody is talking about economic recovery, do you think one is better off still avoiding the infra names, because right now at least the Indian government is cash strapped, and the fortunes of infra companies, whether it's construction, EPC, or a name like L&T, is there's a large dependence on government spending?
In context, I would say yes. While we are seeing industrial companies in North Asia like China and Korea outperforming and having their earnings estimates revised upwards, they're not really figuring in the beneficial category in the Indian context. And I think the point you made is right. In case of India, the quantum of the fiscal stimulus has been relatively low, in fact, quite significantly low compared to what the developed markets and some of the other larger Asian markets have done. And as a consequence, I think industrial recovery or even into incremental investments in infrastructure and even private consumption would obviously be delayed. Today, we are in a situation where average capacity utilization is less than 70%. It's hardly about 65 to 66%. So it would be unrealistic to expect any major industrial company to perform in that situation where, either the consumer companies, the consumer discretionaries, or the other companies are unlikely to expand their capacities in any significant manner.
How's India looking relative to other emerging markets right now?
Well, in our Asian model portfolio, we are still overweight India, despite the fact that the macroeconomic picture does not really look that positive in relation to some of the other markets, particularly those in North Asia, which have staged a firmer recovery compared to India. In case of India, our approach is really stock picking. And we realize that India offers a degree of spread to the global and regional investor, which many other Asian peers don't really offer. And by spread, I mean different sectors which are actually driven by different drivers, some domestic and some international. There is a set of good quality companies that are available in each of these sectors, which possibly offers a large enough universe to both foreign and domestic investors to choose from. Look at one important data point. Look at the last 4 months or so. Foreign institutional investor inflows into India have been positive in each and every month: May, June, July, August. North Asia had a bit of an incremental foreign positive inflow in the month of June and July. That again subsided to a negative number, an outflow, in the month of August. But and South Asia, if you look at the ASEAN markets, they have had consistently negative consistent outflows in pretty much all the months of this year. So this exception that India has benefited from, pretty strong inflow for the last 4 or 5 months, actually underscores that particular characteristic of the Indian market, which is a pretty broad range of sectors and stocks which are often uncorrelated, which is being offered to the investor base. I think even corporate action in terms of the large private banks raising capital, that has helped as far as foreign portfolio inflows are concerned. But it's really that spread of large and sectors and stocks that possibly has helped the market.
Absolutely. You mentioned stock pickers market and the overall strategy, but would you like to share with us some of your other preferred pockets right now, Manishi?
I talked about the private sector banks and insurance. We continue to put our faith in that segment. We also like the IT services sector. We think the sector is finding new ways of saving cost, and also some of the large leading companies are kind of rediscovering their product offering. We like the consumer staples sector selectively. We again, particularly the frontline large companies, which are benefiting from this renewed focus on sanitation and hygiene. And finally, despite the uncertainties, the recent uncertainties, we still like the telecommunications sector. Both the pure plays and the conglomerates who are operating in that segment. So that really, in a nutshell, covers our sector-wise allocation in the Indian context.
All right, Manishi, we leave it there. Thanks so much for joining us this morning.